Welcome to the show. You have found Mason Street Retirement Insights, where every week we turn to our resident financial advisor, Sean Mason. He is the founder of Mason Street Wealth Management right here in Fresno. And he's been helping clients retire with confidence for years. He'd love to do the same for you. So he is here today to break down some of the biggest retirement topics for us. All right, Sean, as we get things rolling today, I wanted to start with something that I think a lot of people right on that retirement edge have probably been hearing and even wrestling with this. The CEO of JPMorgan Chase, Jamie Dimon, he recently offered advice for people who are on the edge of retirement. And when he mentioned diversification, it was not just about spreading your money out among different stocks or sectors. He also talked about investing in and out of the market. So I was reading through this and I was wondering, Sean, if you could explain what Jamie really means by this to us.
Yeah, for sure. I mean, Jamie Dimon, he's been around a long time. So, the industry does keep an open ear for him. And he makes some good points here, probably obvious to many of us. But diversification is, of course, foundational in risk management. But to your question, Casey, Jamie seems to be referring to stocks and stock funds when he says the market. And I think most of us would consider other asset classes being part of the market: bonds, REITs, buffer funds, and others.
Well, yeah, I think that's an important distinction because a lot of people hear the market and they automatically think, stocks only. So when you're talking about looking beyond just stocks, how do you decide which of those other asset classes even make sense for somebody?
Well, yeah, and for sure they should all be on the table, just depending on the current economic environment. But, part of this will depend on your strategy. If you subscribe to more of a buy and hold allocation, then equal weighting into multiple asset classes is going to be key. But then on the other hand, you might over or underweight certain sectors if you're paying attention to the current events.
Okay, so this really isn't a one-size-fit-all decision. Some people are more comfortable staying steady and others are paying closer attention to what's happening around them. So how much does that come back to risk tolerance?
Well, regardless of your strategy, risk tolerance has to be front and center in designing the investment portfolio. And there's two types of risk tolerance. That which is more pragmatic, it's based on math, and then the other being emotional, or how we feel about the roller coaster ride. And both are equally as important to serve quality of life.
Well, I think the emotional side that you mentioned is interesting because on paper, something might make sense, but living through it can feel very, very different. So talk to us about how you help people figure out where they really fall on that spectrum.
Yeah, well, we never want to put ourselves in a position of forced selling because of income needs. If a holding is down and we have to sell because we need the money, that's mathematically just like paying a penalty. So the strategies you use to reduce that risk will determine which asset classes you're investing in.
Well, okay, let's talk about what that looks like in practice then. When you're trying to reduce that kind of risk, where do you typically start the conversation with your clients?
Well, they might be thinking that bonds are going to be their saviors. If you're willing to forego some growth and you're happy with 3 or 4% interest, on the other hand, you might decide bonds are your savior. If you're willing to forego some growth and you're happy with 3 or 4% interest, you might even get some appreciation value if interest rates go down. But bonds haven't been real productive in the last several years. We've actually leaned towards fixed indexed annuities as a bond replacement. They have strong guarantees, protecting the principal from market losses, with the potential for reasonable rate of return, based on increasing index values.
Okay, and then for somebody who still wants a little more growth potential?
Well, if you're looking for more growth potential, then you might start choosing structured notes or buffered funds. These strategies can help reduce your downside exposure while capturing more of the upside. Also think about dividend stocks. They can also be used to hedge against market volatility. They're usually the staples or non-discretionary category, and consumers are usually more focused on the essential products and services during those recessionary times. So these companies can tend to be more resilient. It's also important to identify those companies that have proven to pay the dividend when their stock prices devalue. That dividend can serve as the growth rate while prices recover, and they're also helpful if you need to take distributions for income.
Okay, so Sean, if somebody is hearing all of this and they're realizing that they might be over-concentrated in one area, what's a smart first step that they should be taking?
Well, I'm going to suggest that they come in and have a discussion with us. You know, there's so many different strategies, and there's part of it is what you're trying to accomplish. And I find when people come in that what they're trying to accomplish, part of it can be a little blurry. You know, they're hearing a lot of information, they're hearing a lot of noise out there, and it's just really important to try and kind of sift through all the noise and get to what's important for your individual situation.
So, okay, our key takeaway from discussing, what Jamie Dimon was saying when he talks about being in and out of the market, would you say it's fair to say that it's less about timing and it is more about structure?
For sure, it's more about structure, and that was really well put, because it should not be about timing. That's really tough. Look, nobody has a crystal ball. You don't know what the timing is. Yes, you can be paying attention to our current economic environment and the data, and you can work on probabilities, which we want to do. We always want to work on probabilities. We're going to win in the end if we do that. But the timing is almost impossible to call. So you need structure to kind of handle whatever the environment might throw at you. And so I mentioned that I would suggest that people come in and have a discussion. I think it's a great opportunity for people to come in and get some insight into how all these things work together. And so we're going to invite our listeners to come in for a retirement planning assessment. Taxes, estate planning, distribution strategies, all those different elements that you have to be considering. And, for those people that have accumulated $500,000 or more, and I say $500,000 or more because that's really when our strategies can be impactful. But for our first 5 callers, we're going to do this retirement planning assessment with no cost. I think it's that important for you to come and have it done. So give our team a call at 559-847-0039. Our team will find a convenient time for you to come into the office or meet by Zoom.
That is going to do it for us this week here on Mason Street Retirement Insights. As always, thank you so much for joining us, and we will be back next week, same time, same place, with more great insight from Sean Mason, president of Mason Street Wealth Management. Take care.
Mason Street Wealth Management, MSWM, is a registered investment advisor, and the opinions expressed by MSWM on this show are their own and do not reflect the opinions of Motivate Investments. Registration is not an endorsement by securities regulators. Investment advisory services are offered through Motivate Investments, an SEC-registered investment advisory firm. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. By contacting us, you may be provided with information about insurance products, including annuities, offered through Sean A. Mason, California, insurance license number 0B54860. The firms are separate entities. Annuity guarantees rely on the financial strength and claims-paying ability of the issuing insurance company and are not offered by Motivate Investments. Read your contract for restrictions, limitations, or penalties. MSWM is not licensed in all 50 states. To find out if MSWM is licensed in your state, please call 559-892-0002.